Welcome to the Commercial Property Podcast. My name is Suzi Carter. I am a chartered surveyor. I've been involved in commercial property in the UK for 30 years and I've done hundreds of commercial property deals. I'm here to be your guide through the commercial property market, whether you're an experienced investor or whether you're literally thinking about dipping your toe in the world of commercial real estate. I will be here talking to you about all kinds of things commercial real estate in the UK, and I've also got some fantastic guest experts who are joining me. So please do subscribe if you'd like to follow, and if you'd like any more help or information on commercial real estate, please do click www.suzicarter.com, which is my website, and you can find out all the ways I can help you. So stay tuned for this week's episode. Welcome back to the Commercial Property Podcast, and today I'm going to be talking to you about some of the risks that investing in commercial property might bring. And I'm not highlighting these so that it creates fear or to discourage you from investing. Actually, far from it. I genuinely believe that forewarned is forearmed. And whenever we are building a portfolio, we need to be very aware of the risks up front before we invest so that we can basically mitigate them. And when I was in the corporate world, a lot of my thinking comes from the corporate world, working for big PLCs who have lots of checks and balances in place when they invest. And I think as SME investors, we could take a lot of notes from the corporate world, because obviously when you're investing huge sums of money, you want to make sure that you've thought about the risks and you've thought about mitigants for the risks. And my logic is, why would we be any different? So when we enter into our investing, an awareness of the risk around the assets means that either we can mitigate them up front or we can at least plan the mitigation. And actually, sometimes we may choose not to invest in that particular asset because we've thought about those particular risks. So this isn't about being frozen in indecision or inactivity, far from it. It's about making sure we invest in the right assets and we have the correct strategy so that we can make loads of money from commercial property, because that's what it's all about, right? So I share with my clients kind of a risk matrix, and whenever they can make investing decisions, they can refer to the risk matrix. And it just means that you are basically forewarned and forearmed with regard to some of the potential risks. So let's get going, because property has its own unique risks, and each type of property has its own unique risks. So, market risk is a biggie. And we're talking not only about the commercial property market, we're talking about the UK market for property, but also the economy. We're talking about the global economy and the global market, because we're so intertwined and interconnected these days that globally things have an impact. So just take Trump's tariffs, what happens to interest rates in the States with the Fed have a direct impact on what happens in Europe and in the UK. So we can't ignore global factors, obviously wars, global uncertainty, trade wars, it all has an impact, especially with commercial property, because obviously we're talking about businesses, and in commercial, anything that affects a business affects commercial property or a certain part of commercial property. So market risk is a really big one. Sentiment very often governs markets. So, is sentiment high? Is sentiment low? Where's the economy going? What's happening with the government? So regulatory risks. We've seen an announcement that the government wants to get rid of upward-only rent reviews in the commercial property market. What's the effect? It's pretty obvious. There's uncertainty in the market. A recovery that we thought was happening now doesn't look like it's going to happen because of this uncertainty. And, I think when government makes policies, sometimes they just don't think of the knock-on effects. And really, what UK PLC needs now is confidence from overseas investors to come back into the UK commercial property market at the top end, and confidence amongst the institutions, to keep investing, and confidence amongst businesses to take long leases, because ultimately that's what gives a recovery in the market. Ultimately, that's what it's about. So market risk, and obviously within that is sector risk. So every sector of commercial, and that there's lots of them, remember, and anything is occupied by a business is commercial property. So business risk, anything that affects businesses will affect commercial property. So for example, when at the budget last year, when business rates uplifts happened, when employers' national insurance increased, minimum wage increase, that's got a direct effect on business. And different sectors will be affected differently. So, in a sector that's already struggling, more regulation, more cost, like leisure, hospitality, retail, obviously creates a bigger burden than maybe in sectors that are booming more like industrial. So the way we can mitigate, and obviously with each of these risks, we need to mitigate. So obviously a mitigation for market risk and sector risk is that we diversify. So this obviously flies slightly in the face of what I talk about with regard to niching. I never say with niching that you just need to have one niche. You can have 2 or 3 niches as long as you really understand them. I'd recommend you start with one and then you move on, onwards from there. And obviously diversification can really mitigate risk, especially if you diversify outside of property as well, into different types of asset class. So market risk, sector risk, and macro and microeconomic risk. And of course, one of the benefits of niching is that on a sub-economy, on a microeconomic scale, there can be factors that are just bucking the trends of what's happening more globally or in the whole of the UK. So there's certain investing locations that I work in where the socioeconomics are kind of far better than the average. There's very unique factors that mean that the retail is booming. There's very short high streets. There's a very particular type of retailer that wants to cater for the wealthy customers and the big houses surrounding it, which means that actually you don't get national brands, but you get smaller, medium-sized retailers who want to take longer leases because of the competition. They want to make sure they secure their spot in that particular investing location. So niching can kind of buck some of these factors in the economy, because it means that there's a very unique set of local factors that kind of are counterintuitive in relation to what's happening more globally. Then we're talking about liquidity risk. So liquidity risk in any type of property is very, very real. What that means is that, with stocks and shares, you can offer your shares into the market and they can be bought and sold pretty quickly. To some extent, the same with kind of crypto and bonds, etc., although you may be tied into bonds for a little while. But property goes through a process. The most liquid type of sale of a property is at auction, and obviously that comes with an amount of risk, especially in terms of pricing risk. And so it's just a thing. It is a thing in terms of property that there is low liquidity. Now, that's why we always have multiple exits. So the way to mitigate this is to work out your multiple exits. So, for example, if you want to let the property as a whole, then think about whether it splits into part. Think about different types of uses. Think about whether you could use permitted development planning or planning to convert to different types of uses where there's more demand, maybe higher rents, maybe higher capital values. Think about title splitting, disposing of part, which is more relevant. Subdividing space so that there's higher rents. So many different ways you can exit commercial property. And when I say exit, I don't mean sell. I mean that you've worked out different asset management angles and potentially different sale routes. And that is really, really important because especially with commercial, which is governed more by economic factors than residential. At the end of the day, house prices rise and fall, but everybody needs houses. There's certain types of commercial property that potentially may not be commercial property in 20 years because different sectors are being affected at different rates and in different locations. So that's why we look at multiple exits. And if we've got lots of multiple exits on a property, then we can be much more, and they all stack, obviously they all need to stack in terms of the numbers, then we can be quite sure that we've got our downside covered to some degree. And of course, we always keep reviewing that in the whole of our portfolio, making sure that that's the case. And then we want to look at finance risk. So that's both from a global level in terms of inflation, interest rates, etc., loan to values, how the banks are feeling about the sector. So what we saw when the market dropped in after Liz Truss's budget is that banks really restricted their lending policies. Loan to values fell, rates went up, obviously as interest rates went up. And importantly, they instructed their valuers to value a lot of the time, if you didn't have a blue chip covenant on longer than 5 years, on vacant possession value, basically assuming that that property was vacant. Now, what's really interesting recently is that they're starting to change their lending policies and are much more willing to lend on market value, i.e. they actually kind of will assume that if there is a tenant in the property, that actually they can value the benefit of that. So obviously in higher interest rates can increase borrowing costs. So whenever you're looking to buy something, you need to make sure that you kind of do sensitivities on different levels of interest rates and different loan to values to make sure that you're future proofed again. Also in terms of, your current financing and also any credit risks of valuation. And, ultimately what we don't want to do is be forced sellers because, as you will have seen from valuation reports, that really does subdue property value. So we need to make sure that that's not the case. And, different types of finance, rather than being totally reliant on one bank, diversifying your finance, maybe having private bridges or private investors, having your own equity in there, thinking about your loan to value, whether you want to be really highly leveraged or whether you want to be lower leverage, because over leverage can magnify losses in a downturn. So you just need to make sure that there's no massive risk. And obviously then you've got valuation and appraisal risks. Make sure that that reflects reality. And then obviously your exit risk as well. And then when you are appraising a property, either before you buy or during the term of your ownership, there's also tenant risks.
This episode is brought to you by Bond Finance Limited, your trusted partner for commercial property mortgage solutions. Are you an experienced residential property investor about to diversify into commercial property, looking for funding options? Bond Finance can help. Whether you're planning to expand, refinance, or make a major property investment, Bond Finance provides expert advice with access to a wide range of lenders, from high street to specialist. Book a free discovery session today to explore how we can tailor commercial funding solutions to your unique investment strategy. Visit www.bondfinanceltd.co.uk and take the next step in your commercial finance journey.
So, the tenant covenant, we should be doing tenant checks. And if the tenant is a SME or a startup, we want to have guarantors. We might want to have personal guarantees. Certainly we'll want to have rent deposits in there. We want to be assessing their risk of default, the business failure. And obviously that comes back to sector risk as well, and location risk, in terms of, kind of what's happening in that location. Are there big rows of empty shops, or are there is vacancy pretty good? That's really, really important. So void risk is super, super important. And then you've got property management risks. So health and safety in particular, effective rent collection, making sure your tenants are paying on time. And if they're not, maybe you're kind of sending the bailiffs in, or to making sure that you're being quite firm with your tenants, making sure that you implement your lease renewals on time, making sure that you implement rent reviews properly and effectively. And then layered on top of that, you've got operational risks. So, your systems of service charge collection. And as I said, kind of health and safety is super, super important, because at the end of the day, that's your kind of that's a big exposure. And reading your lease, lease risk is super important. Read your lease and work out whose liability is what, and making sure the tenants are actually complying with their covenant. That is very, very important. Then you've got building risk, the physical state of the building. So, if you're buying and don't do a building survey, I wouldn't recommend it. Very, very strongly wouldn't recommend it. But Are there defects? Are there inherent defects, structural defects that need to be rectified? Do you know that there's going to be a big planned maintenance program? Have you deducted that from the purchase price? Is there any building obsolescence? What about EPCs? EPCs are just getting tougher. And actually, if there's no scope to increase your EPC, which actually there usually is, then you need to make sure that you've got the ability to do that, or you do that straight away. Obviously, if you're doing building works, then you've got construction risk and cost risk. And build costs obviously have been on the increase, and you've also got kind of things like flooding risk, asbestos, contamination, all things that you need to look at. And then you've got kind of regulatory risk. I mentioned about upward only rent reviews, but compliance, etc. It is really, really important. So, that's just a smattering of some of the risks that you might encounter in commercial property. I want to kind of highlight those because they are really, really important. But what I don't want to do is kind of scare you, because ultimately all of this can be mitigated. And I think it's a real warning sign if you're buying a property and you hit these risks head on and you can't mitigate them. Because if you can't mitigate them, I would say that you're pretty highly exposed. So unless you're pivoting to a different use where, you can mitigate the uses, then I would say you need to treat that asset with a high dose of caution. So there's certain types of assets that I just wouldn't touch with a barge pole, genuinely, using the technical term, because I just don't think that they're future-proofed. I don't think that going forwards tenant demand is going to be strong enough, because we want to make sure that we have strong supply versus demand versus supply in our markets. I don't think the markets are strong enough. And, yes, they might be cheap, but there's probably a reason why they're cheap assets. And so, the decisions you make as to what not to invest in are as important as the decisions you make as to what you actually invest in as well. So the process I would strongly recommend that you go into, or you go through as part of this process, is that you think about all the risks associated with the property, put some kind of scoring matrix in place, maybe from 1 to 5, and look at whether you can either mitigate the risks up front. Obviously, there's a lot of due diligence you can do. So building risk, you can get building surveys, asbestos surveys, contamination surveys, all kinds of things, structural surveys, etc. See if you can mitigate them up front before you purchase. And then there's some that, in case things happen, scenarios happen, you've got a plan ready. That's why we always talk about multiple exits. That's why it's so important. And then in your ownership of the property, during the period that you hold that property, commercial property is really hands off, but it's definitely not passive. No investment is ever passive, because you do need to review your portfolio. You do need to see whether your tenant is as good as they were when they took over, because quite often, tenants' trading can be affected by macro and microeconomic factors. So, are they particularly vulnerable? So, for example, you might want to let to a service-based tenant who is kind of more Amazon and COVID and economy-proof, basically. An internet proof, because that might give you greater certainty. And so your actual kind of your very methodical and deliberate tenant choice will mitigate some of the risks that you might have in a particular investing location because of those factors. Equally, in terms of the length of the lease, if you can get a long lease in place, then you could ride some of those factors. Selling before, maybe if you see the kind of sector you're in kind of starting to take a downturn, maybe selling before that curve reaches the bottom. There's lots of different ways you can mitigate risk, but an awareness of risk is the most important thing. So, multiple exits, absolutely key, and due diligence before you buy the property. So, pre-warned is pre-armed. Make sure that you just think about this stuff before you buy. And, if you're still happy to purchase, then crack on and make sure that you just keep reviewing these risks during the period of your ownership. And, hopefully you should have a fantastic investment. So hopefully that's useful today. And I look forward to seeing you next time on the Commercial Property Podcast.